Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Mark Odo. He's the chief portfolio manager over at Swan Global Investments, and we're going to take a look at alternatives to the bond market to hedge against stock market volatility. Mark, it's great to have you with us. Certainly this week, we have seen volatility back in the market, in fact, for the entire month of August.
Yes, indeed.
All right. And it's certainly a different narrative than what we've seen where everything's kind of up and everything's kind of down at the same time. But specifically, we're going to focus on fixed income. And I think the question is the bond market out of gas?
Well, I'll be honest. For the last couple of days, with all this volatility in the market, bonds have been a great investment. We've seen people flood into them. And if you look at the long term, going back for the last 40 years or so, bonds have been great. Bonds have added a lot to portfolios. Our concern with the bond market, however, is looking out over the next 5 to 10 years. We see lots of challenges ahead for the bond market. And we don't think that bonds are necessarily going to fulfill that role of providing both capital preservation and income in most people's portfolios.
All right, now when we take a look at the Treasury market, are there risks and challenges with that?
Yes, definitely. In the Treasury market, lots of the returns have been driven by this long fall in interest rates. If we go all the way back to the 1980s, interest rates were over at 15%. And as they came down, that was very, very good for bonds. But they don't always go the same direction. If we roll the clock back a little bit and see what the picture looked like prior from the post-war period up until the early 80s, this was a period when interest rates were rising. Now, during this time, we saw the real return, the inflation-adjusted return for bonds actually be negative. Now, people don't know exactly where bond yields are going to go going forward, but can they go much lower? If they go negative, that's not going to really help a lot of people, right? I mean, that's going to be dead money. You're not going to get much income if you have 1% yield. You look at Europe, zero. Negative yields. We have people paying other people to hold their money with a negative yield environment, and that's absurd to me. So if yields go down, it's a lose situation. If yields go up, you have this type of situation where bonds lose value. So it's kind of a lose-lose proposition for a lot of bondholders.
All right, now what about the corporate bond market? Is there a bulge at the bottom?
Yeah, corporate bond markets face some of these challenges, but some other additional challenges as well. There is a large bulge of issuance that is sitting on the lowest rung of the ladder when it comes to the grading of the market, just the credit quality. Well, I would call the true single A, double A, the true investment grade market, that's only about a third of the market. You have this huge bulge here, which is almost entirely equal to the high yield market, which is just sitting right there on the cusp of being downgraded to investment grade. Now, granted, we are in a situation here where the economy is still doing well, but should some of these companies get into some liquidity problems and some downgrades, you might see this huge bulge here of $2.5 trillion in investment grade debt be pushed down into the non-investment grade sector.
And the non-investment grade segment of the market, anything interesting going on there?
Well, that is also impacted by some of this. Because there's been so much money chasing yield at this point, people have become very liberal and very loose with their lending standards. When you get to the leveraged loan market, there's what's known as the covenant light issuance, where the people who are borrowing money don't really have to follow a lot of rules. They have a lot of leeway as far as how they manage their business, manage their balance sheets, and as a result, it's almost 3/4 of the issuance. There's hardly any covenant protection for those high yield bond holders, those leveraged loan holders.
Now, modern portfolio theory, you could debate this back and forth all day long. We know it's a very hot topic in the FinTwit landscape, but if bonds face such poor prospects going forward, is that 60-40 model broken?
Well, I will say that the 60-40 model has worked splendidly for the last 40 years or so. If you look at the 60-40 model, it's averaged about 10.4% annualized going back for 40 years, which should get you to your financial goals. But the key driver to that was bonds were providing a 7.7 rate of return throughout that period. Now, based on some of these factors we discussed here, does anyone think bonds are going to give you 7-8% going forward? Probably not. What if it's 2%? What if it's 0%? Now, if bonds give you only, say, for example, 2% here, and that makes up 40% of your portfolio, in order for your overall 60-40 to get you an 8% rate of return, equities are going to have to carry a lot of the weight. They're going to have to give you a 12% rate of return just to get to the 8%.
All right. Now, to wrap up here, are there alternatives to bonds to manage stock market risk then?
Well, that's what Swan Global Investments is all about. Our whole philosophy is that the biggest risk that any investor faces are these large bear markets that do come along. Now, granted, it's been 10 years since we've seen the global financial crisis, but we have seen the two biggest bear markets since World War II hit us since the start of the new millennium, the dot-com crisis and then the global financial crisis. And we can see what a feast or famine image that creates here. Off to the left, we see the 10-year returns of the S&P 500. And we might have 10 years where the markets are just taking off. It's great. We might have 10 years, which you could call call a lost decade, where you actually lose money. And for us, that's too much variability there. Now, if bonds cannot play that protective role going forward, our belief is that you must hedge your protection. You must hedge your investments. And that's what the defined risk strategy is all about. We are always invested, but we are always hedged. We use put options to protect on the downside. And you can see, having done this for 22 years, this has given us very stable results. Doesn't matter if it's feast or famine in the markets, we're giving you consistent results.
All right, and to wrap up here, what do you expect with bond yields in the future?
Whew, like I said, it's kind of a lose-lose situation.
Yeah.
I think in the short term it is going to go down for a while. I think in the longer term, with all the demographic and debt and deficit problems we have, they're going to go up. So people might get whipsawed. They might get stuck with low yields for several years, and then when interest rates start going up, they'll start losing value on their bond investments. Really a lose-lose situation.
Right, you can see why the right side of the chart is a little bit more comforting. Mark, so great to have you with us at MarketSite. Thanks for joining me. And thank you for joining us on Trade Talks. I'm Jill Malantrino, Global Markets Reporter at Nasdaq.